There is a particular kind of financial destruction that does not announce itself. It does not arrive with a market crash, a bankruptcy filing, or a margin call at 2 in the morning. It moves quietly. It wears the costume of discipline. It presents itself as prudence, as ambition, as common sense. And by the time you recognize it for what it is, a habit that has been slowly, methodically hollowing out your financial life, it has already done most of its damage. I have spent more than 5 decades in markets. I have watched the credit cycle turn from feast to famine and back again more times than I care to count. I have seen brilliant people with credentials, resources, and every apparent advantage, make the same category of mistake, generation after generation, in slightly different packaging. And what strikes me every time is not the complexity of the error. It is the ordinariness of it. The mistakes that destroy wealth are not exotic. They are not hidden in some obscure corner of financial theory that only specialists understand. They are sitting in plain sight, masquerading as virtues. Today I want to examine 5 of those habits. Not the obvious ones, not gambling with leverage, not ignoring diversification, not the blunders that appear in every personal finance article written in the last 30 years. I want to talk about the ones that sophisticated, well-intentioned, genuinely thoughtful people carry with them without realizing it. The habits that feel, from the inside, like exactly the right thing to be doing. Because those are the ones that are truly expensive. You can protect yourself against dangers you recognize. It is the dangers that feel like wisdom that will undo you. Let us begin. Habit No. 1. The illusion of the informed opinion. Most people believe that the key to investment success is knowing more than others. More information, more analysis, more data, more research. If they can just gather enough facts, build a comprehensive enough model, consume enough financial media, they will eventually arrive at a kind of private certainty, a clear view of the future that others cannot see. And that certainty, they believe, is the foundation of intelligent investing. This belief is the first wealth-killing habit. Not because knowledge is worthless. Knowledge is essential. But the habit I am describing is something different from knowledge. It is the conviction that more information produces proportionally more clarity. It does not. And the investors who operate as though it does make a very specific, very costly mistake. They confuse the feeling of being informed with the reality of having an edge. Think about what an edge actually means. In any market, equity markets, credit markets, real estate, anywhere capital is deployed in competition with other capital, an edge exists only when your conclusion differs from the consensus, and your conclusion is correct. Both conditions must be true simultaneously. If your conclusion matches the consensus, the expected result is already in the price. You will earn a consensus return, which is to say an average return, which is to say no edge at all. If your conclusion differs from the consensus and you are wrong, you have simply constructed an elaborate justification for a loss. The edge only exists in the narrow space where you are different and you are right. Here is what this means for the habit of information consumption. More information, consumed from the same sources as everyone else, processed through the same analytical frameworks, taught in the same business schools, tends not to produce differentiated conclusions. It tends to produce consensus conclusions held with more conviction. And conviction, absent genuine differentiation, is not an asset, it is a liability. It makes you more confident at exactly the moment you should be most uncertain. It makes you less likely to question your assumptions. It converts the intellectual humility that good investing requires into the intellectual arrogance that destroys it. This is what I have called, in various forms over the years, the difference between first-level thinking and second-level thinking. First-level thinking takes the available information and draws the most obvious conclusion. The company reported strong earnings. The stock is a buy. The economy is growing. Equities will perform well. The central bank is cutting rates. Bonds will rally. These conclusions are not wrong because they are simple. They are wrong because everyone who is looking at the same information and thinking about it in the same way has already arrived at the same place. And when everyone has arrived at the same conclusion, the market has already moved to reflect it. Second-level thinking asks a harder question. Not what is the situation, but what does everyone else think about the situation? And is there a reason to believe they are wrong? It is a question about consensus, not just about fundamentals. And it is a discipline that is genuinely rare, not because it requires unusual intelligence, but because it requires the willingness to stand apart from the crowd, which is psychologically costly in ways that no amount of information can compensate for. The practical damage this habit inflicts is significant and compounding. Investors who confuse information accumulation with edge generation tend to overtrade. They respond to every new piece of data as though it provides novel instruction. They rotate in and out of positions based on developments that the market has already processed. They generate transaction costs, tax friction, and timing errors, all in the service of a conviction that does not actually exist. And because they feel informed, because they can cite the earnings report, the Fed minutes, the analyst upgrade, they rarely question whether their activity is producing value or destroying it. The escape from this habit is not to consume less information. It is to change the question you ask about information. Not, what does this tell me about the future? A question that flatters the illusion of foresight. But rather, what does everyone else already believe? And what would I have to conclude that is different? And why would I be right when they are wrong? If you cannot answer that last part convincingly, you have information. You do not have an edge. Knowing the difference is the beginning of real investment discipline. Howard Marks on second-level thinking and investor psychology. The most costly illusion in personal finance is the belief that more research automatically translates to better decisions. Habit no. 2. Treating risk as a number. The financial industry has invested enormous intellectual energy in making risk quantifiable. Standard deviation, beta, value at risk, Sharpe ratio, maximum drawdown. These are the instruments on the dashboard of modern portfolio theory, and they have a certain aesthetic appeal. The appearance of scientific precision applied to a domain that is stubbornly, irreducibly uncertain. The habit I am describing now is the habit of believing those numbers, not just using them as rough guides or contextual tools, but genuinely, operationally treating a quantitative risk metric as a meaningful statement about the danger actually present in a portfolio. It is a habit that has done more damage to more institutional and individual investors than almost any other single practice I can identify, because it creates a false sense of control at exactly the moment when control is an illusion. Here is the fundamental problem. Every quantitative risk measure is constructed from historical data. The models learn from the past. They are calibrated to historical volatility, historical correlations, historical drawdown patterns. And in ordinary times, in the stable mean reverting stretches of market history that make up the majority of calendar days, they function reasonably well. They produce numbers that feel informative and actionable. They give risk managers something to report, boards something to approve, investors something to monitor. But risk, as I understand it, is not primarily a property of normal times. Risk matters at the extremes. Risk matters in the tail, in the events that historical models, almost by construction, assign low probabilities to. And it is precisely in those extreme moments that historical correlations break down, that assets which were uncorrelated begin moving together, that the diversification the model measured disappears, and that the number on the dashboard bears no relationship whatsoever to the danger in the room. Think of it this way. Imagine you are measuring the structural integrity of a building by counting the number of times it has swayed in past storms. If the building has stood for 30 years without a major failure, your model will assign it a high safety rating. But what the model cannot tell you is whether there is a crack forming in the foundation that previous storms were not severe enough to expose. The model measures history. The risk is in the future. And the future, as anyone who has experienced a genuine financial dislocation knows, has a habit of introducing conditions that history has not yet recorded. The 2007 to 2009 financial crisis is the case study here that I find most instructive. The risk models in use at every major financial institution in the world were, by their own internal metrics, performing excellently. Spreads were tight. Volatility was low. Correlations were stable. Every dashboard said low risk. What every dashboard could not measure was the accumulation of structural fragility in the housing market, the leverage embedded in the structured credit products, the procyclical feedback loops that would convert a modest correction in housing prices into a near collapse of the global financial system. The risk was not visible in the numbers. It was embedded in the architecture, and when it manifested, the numbers were not just useless. They were actively misleading. They had created false confidence during the period when caution was most warranted. The habit of treating risk as a number is wealth killing, not because measurement is wrong, but because measurement is incomplete in ways that matter most when the stakes are highest. Real risk, the risk I care about, the risk that has shaped my thinking across 50 years of investing, is the probability of permanent loss of capital, not temporary drawdown, not volatility around a mean, permanent impairment. And that risk does not live in a spreadsheet. It lives in the quality of your analysis, the price you paid relative to intrinsic value, the structural soundness of the asset, the leverage in the system, and the temperament you bring to periods of market stress. The correction to this habit begins with a shift in the question you ask about risk. Not what does the model say my risk is, but what could go wrong that the model would not capture, and how bad would that be? Howard Marks' investing philosophy has always treated this as the primary question. Not can I optimize my risk-adjusted return in normal conditions, but can I survive the conditions that nobody is currently considering? Wealth building requires a respect for the risk that cannot be measured. That is not a counsel of paralysis. It is a counsel of honest accounting. Habit no. 3. Confusing a rising market with personal skill. There is a bias so universal in investing that it operates almost as a law of human psychology. When an investment rises in value, the investor attributes the gain to insight, discipline, and superior judgment. When an investment falls in value, the investor attributes the loss to bad luck, unpredictable events, and forces outside anyone's control. The gains are skill, the losses are noise. This is not a description of foolish or unsophisticated investors. This is a description of virtually every investor, at every level, operating in every market. It is one of the most well-documented findings in behavioral finance. And it is the third wealth-killing habit I want to address. Because in bull markets, which can run for years and even decades, it silently inflates the investor's confidence to a level that will eventually produce catastrophic behavior. Here is the mechanism. When markets are rising broadly, almost every portfolio participates. The investor who holds a diversified basket of equities, the investor who concentrated in a single sector, the investor who made highly speculative bets that happened to align with the prevailing trend, all of them earn positive returns. The returns are real. The money is real. But the process that generated the returns is very different across these three investors. And the critical mistake is failing to distinguish between returns generated by skill and returns generated by the direction of the market itself. I have a simple mental exercise I find useful here. Ask yourself, if the market had moved exactly sideways during the period in question, what would my returns have been? If the answer is significantly lower or approximately zero, then most of what you earned was market beta, the passive reward for holding risk assets during a rising market. That is not a critique. Beta is real, and capturing it intelligently is a legitimate investment strategy. But it is not skill, and conflating it with skill will lead you to take on more risk in the next period than your actual skill warrants, at a price that reflects the optimism of the prior period. The historical pattern here is one of the most predictable in all of investing. Extended bull markets create a cohort of investors who have experienced consistent gains and who have processed those gains as evidence of competence. They increase their position sizes. They concentrate in the assets that produce the best returns. By definition, the assets that are now most expensively priced. They reduce their cash buffers because cash has been an unnecessary drag on performance. They extend their time horizons, implicitly assuming that the conditions that produced past gains will persist indefinitely. They are, in other words, maximally exposed at precisely the moment when the expected future return is most compressed, and the potential downside is most severe. And when the market turns, as it always does, because the pendulum never stops at the center, because the cycle is not a metaphor but a description of how capital markets actually function, these investors do not simply lose the gains of the recent period. They lose more. because they entered the decline with maximum exposure and minimum liquidity. The skill they believed they had was a product of the environment, not of their process. When the environment changed, the skill disappeared. What remained was the risk. The honest correction to this habit requires a discipline that cuts against human nature. Attribution analysis. After every significant gain, ask not just how much you made, but why. What percentage of the return was attributable to market direction? What percentage was attributable to sector or factor tailwinds you happened to be exposed to? And what percentage, if any, was genuinely the result of an insight that differed from the consensus and proved correct? If you perform this analysis with intellectual honesty, the third category is typically smaller than you expected. And that should calibrate your confidence accordingly. This is not pessimism. This is realism. And in investing, realism is the only foundation on which durable wealth can be built. The investors who confuse a rising market with personal skill eventually get the test. The test always comes. Common investing mistakes around self-attribution are among the most expensive in the field of behavioral finance and long-term wealth building. Habit No. 4. The asymmetric treatment of time. If I were asked to identify the single most structural difference between how wealthy families maintain capital across generations and how most individuals experience their financial lives, I would point not to investment selection, not to asset allocation, not to tax strategy. I would point to their relationship with time, specifically to how they treat the asymmetry between the time horizon required to build wealth and the time horizon over which most people actually make decisions. Most people operate with an implicit investment horizon of somewhere between 6 months and 3 years. This is not a deliberate choice. It is an emergent property of the environment they navigate. Markets report prices daily. Financial media produces commentary hourly. Portfolio apps update values in real time. The infrastructure of modern investing is built to make every moment feel consequential. Every price movement feel like a signal. Every development feel like instruction to act. And the effect of this environment is to compress the investor's effective time horizon until it bears almost no relationship to the actual time frames over which investment outcomes are realized. The wealth-killing mechanism here is subtle but powerful. Consider two investments. One produces a smooth, steady return of 8% annually for 20 years, with minimal quarterly volatility. The other produces a 10% compound annual return over the same period, but with substantial year-to-year variation. Some years is up 20%, some years down 15%, with no predictable pattern. Which investment creates more wealth? The arithmetic is clear. The second investment, compounding at 10% over 20 years, produces materially more capital. But behavioral research consistently shows that investors exposed to the second investment abandon it far more frequently, selling during the down years, rotating into the safer first investment, resetting the compounding clock at exactly the wrong moment. The behavioral cost of the second investment's volatility exceeds its mathematical advantage. Because most investors cannot tolerate the short-term signal of underperformance without interpreting it as an imminent verdict on the investment's quality. Being down 15% in year 7 feels identical from the inside to being permanently wrong, and so they exit, they take the loss, they reset, and they never receive the return that was waiting for them in years 8 through 20. This is not a failure of intelligence, it is a failure of the time horizon. An investor with a genuinely long-term orientation, one who has made peace with the idea that short-term price movements are noise and that outcomes are measured in decades, not quarters, would hold through the volatility and receive the superior compound return. The mathematical reality is identical. The psychological experience of navigating it is what differs. And that psychological experience is, for most people, the binding constraint on their financial outcomes. I want to name this precisely, because giving it a name makes it actionable. I call it the cost of the compressed horizon. It is the difference between the return the asset generated and the return the investor captured, and it is almost always negative, because the investor consistently buys after prices have risen and sells after they have fallen. The gap between asset returns and investiture returns is one of the most persistent and quantifiable phenomena in all of finance. It is not caused by bad investments. It is caused by the asymmetric treatment of time, by holding assets over a short horizon and expecting the rewards that only accrue over a long one. The correction is structural. It requires removing, where possible, the infrastructure that makes short-term volatility feel consequential. It requires defining investment success in terms of outcomes that are measured over years, not quarters. It requires building a portfolio you can genuinely afford to hold through a 30% drawdown without being forced to sell. Not because you are certain it will recover, but because you have been honest with yourself about the conditions under which a recovery is plausible, and you have not exceeded your capacity for psychological and financial discomfort. Warren Buffett, who has absorbed more of Howard Marks' intellectual framework than perhaps any public comparison makes clear, once said something to the effect that the stock market is a device for transferring money from the impatient to the patient. This is accurate, but it understates the mechanism. It is not merely patience that is rewarded. It is the structural commitment to a time horizon that is long enough to allow the relationship between price and value to reassert itself. Value exerts a magnetic pull on price, but that magnetic force is not instantaneous. It operates over years and decades, not months. If your horizon is shorter than the magnet's range, you will never feel the pull. Wealth-building strategies that ignore this asymmetry are not strategies at all. They are expensive experiments in market timing. Habit No. 5. The protective illusion of defensiveness. The fifth habit is the most counterintuitive of the 5, and it is the one I suspect will generate the most resistance. Because it looks, from the outside, like virtue. It presents itself as prudence. It feels, to the person practicing it, like exactly the kind of discipline that serious investors are supposed to have. The habit is this: mistaking inaction for safety. Let me be precise about what I mean. I am not arguing against genuine caution. I am not suggesting that holding cash is always wrong, or that avoiding an overpriced market is foolish. The case for defense in certain market environments is one I have made repeatedly and publicly, and I stand by it fully. There are periods, identifiable through careful analysis of valuations, sentiment, credit conditions, and cycle positioning, when reducing exposure is the intelligent, defensible, value-creating choice. But that is a different thing entirely from the habit of treating inaction as categorically safe. Many investors, particularly those who have experienced a significant loss, or who have read enough market history to be aware of the cycles, or who are simply temperamentally cautious, develop a permanent bias toward the sidelines. They maintain large cash positions, not because they have analyzed current conditions and concluded that the risk-reward of deploying capital is unfavorable, but because staying out feels safe in a way that investing feels dangerous. The asymmetry in their minds is absolute. Investing can go wrong. Not investing cannot. This is the protective illusion. And it is expensive in ways that compound silently for years. Consider the nature of the illusion. If you hold 50% of your portfolio in cash in a period when equities return 10% annually, you have not been safe. You have paid a real, quantifiable cost, the opportunity cost of the return you did not earn. That cost does not show up on your account statement as a loss. It shows up as a smaller number than would otherwise be there. It is invisible in the way that foregone outcomes are always invisible. But it is real, and over a decade, it is devastating. The behavioral finance literature on this is clear. Loss aversion, the documented tendency for humans to weight losses roughly twice as heavily as equivalent gains, creates a systematic bias toward underinvestment in productive assets over long time horizons. The pain of a 10% loss registers more powerfully than the pleasure of a 10% gain. And so, unconsciously, the investor tilts toward positions that minimize the probability of experiencing a visible loss, even at the cost of a guaranteed invisible drag on their compounding. Here is where I want to push the reframe most forcefully. The question is not, how do I avoid losing money? That is the wrong question, because it treats all forms of loss as equivalent. The right question is, over my relevant time horizon, what is the range of outcomes that matters? And which behavior, investing or not investing, produces the better distribution of those outcomes. If your time horizon is 30 years and your goal is to accumulate wealth that maintains purchasing power and funds a retirement, then the risk of being permanently underinvested in productive assets is, for most of that period, larger than the risk of experiencing temporary drawdowns. Inflation erodes the real value of cash. Foregone compounding is permanent. A market drawdown, provided you have the structure and temperament to hold through it, is temporary. The asymmetry runs the other way from what the emotionally cautious investor believes. I have a concept for this that I find useful in my own thinking. I call it the false floor. It is the belief that inaction sits on solid ground, that the position of doing nothing has no downside, but the floor is not solid. Beneath it runs the steady current of inflation, the compounding of foregone returns, the gradual erosion of purchasing power, the narrowing of the window in which the investor's capital can compound toward their goals. The false floor holds your weight today. Over 20 years, it slowly gives way. And when you finally step back and measure the gap between where you are and where you needed to be, the damage is done in a way that cannot be reversed by any single decision. The correction is not to become reckless. It is to expand your definition of risk to include the risk of underperformance over time, not just the risk of visible, near-term loss. It is to do the honest accounting that inaction has historically denied itself. If you have maintained a 20% cash position for the last decade because you were waiting for a better entry point, calculate what that waiting cost you. Not as a reason for self-recrimination, what is done, but as calibration for the decision you are making today. Risk is never absent, it only changes form. The investor who believes they have escaped risk by staying on the sidelines has simply traded the risk of loss for the risk of insufficiency. And in a world where living costs compound, where inflation takes a toll year after year, the risk of insufficiency may ultimately prove more damaging than any market cycle. Howard Marks on risk and investor psychology makes this point repeatedly in his published memos. The absence of obvious danger is not the same as safety. Sometimes it is the opposite. The architecture of wealth destruction lay these 5 habits side by side and a pattern emerges. Each one is a form of substitution. The illusion of the informed opinion substitutes the feeling of knowledge for genuine differentiation. The treatment of risk as a number substitutes quantitative comfort for honest uncertainty. The confusion of market gains with personal skills substitutes environmental reward for process discipline. The compressed time horizon substitutes short-term legibility for long-term compounding. And the false comfort of inaction substitutes the absence of visible loss for the presence of actual safety. What they have in common is this: they each replace a hard, uncomfortable truth with a more comfortable approximation of it. And the market, over time, is ruthlessly efficient at billing you for the difference between comfort and accuracy. The most important insight I have arrived at, across 5 decades of observing how intelligent people lose money, is not a specific piece of investment advice. It is a disposition. It is the willingness to sit with discomfort rather than reach for reassurance. To hold uncertainty without collapsing it into false certainty. To distinguish between what you know and what you believe, and to hold the latter with appropriate looseness. To be aware always that the habits that feel most like wisdom are precisely the ones most worth questioning. This is not a counsel of paralysis. It is not an argument for permanent skepticism or reflexive contrarianism. The investors I have most admired over the years, the ones who built and sustained genuine wealth across cycles, were not the most cautious or the most aggressive. They were the most honest. Honest about what they knew and did not know. Honest about the source of their past returns. Honest about the time their goals actually required. Honest about the real cost of both action and inaction. And honest enough to recognize in their own thinking and behavior the fingerprints of habits that felt like wisdom and were actually erosion. The pendulum is always moving. It is moving right now. Whether it is at the end of its arc or somewhere in the middle, I cannot tell you with certainty. No one can. But I can tell you this. The investors who will be standing when it swings back are not the ones with the most information, or the most sophisticated models, or the lowest apparent risk metrics. They are the ones who have identified the habits that were quietly working against them, and who had the discipline and the intellectual honesty to change. That is the only edge that is ever truly durable. Not information, not timing, not genius, just the willingness to see yourself clearly. A final note on what cannot be quantified. There is one more thing I want to say before we close, and it does not fit neatly into a numbered list. The 5 habits I have described are individually costly. Collectively, they are compound destruction because they reinforce each other. The investor who confuses market gains with skill also tends to treat risk as a number, because quantitative comfort feeds the same psychological need as self-attribution. The investor who treats risk as a number also tends to suffer from the compressed horizon, because daily risk metrics create daily urgency. The investor who is seduced by the protective illusion of defensiveness also tends to fall into the information trap, because consuming more data is a way of justifying continued inaction. These are not 5 separate problems. They are a syndrome. Recognizing a syndrome requires more than identifying its parts. It requires stepping back far enough to see the whole, to recognize the underlying disposition that generates each individual symptom. In my experience, that underlying disposition is the desire for certainty in a domain that does not offer it. Every one of these 5 habits is, at its root, a strategy for reducing the discomfort of uncertainty. And every one of them extracts a price for that comfort, in foregone returns, in misallocated risk, in compounding that never happens. The market does not reward comfort. It rewards accuracy, specifically, the accuracy of your assessment of risk and value relative to price. That accuracy is not available to anyone who needs certainty. It is only available to those who have made peace with not knowing and who have built a framework for acting intelligently under conditions of irreducible uncertainty. That framework, built and refined over decades, is what separates the investors who endure from the ones who do not. Closing, let me bring together what we have covered. The first habit, mistaking information accumulation for genuine investment edge. More data consumed from consensus sources produces consensus conclusions, not differentiation. The second habit, treating quantitative risk metrics as meaningful statements about real danger. Models measure the past. Risk lives in the future, especially in the tail events that history has not yet recorded. The third habit, attributing bull market returns to personal skill. When the environment is doing the work, the lesson is in the attribution, not in the return. The fourth habit, the asymmetric treatment of time. Expecting long horizon rewards from short horizon holding periods is not an investment strategy. It is a structural mismatch between behavior and outcome. The fifth habit, the protective illusion of inaction. Risk does not disappear when you step to the sidelines, it changes form. The false floor of cash has its own quiet cost, and over decades, that cost compounds into something very serious. Here is what I want to ask of you. Not a subscription, not a share. One specific act. In the next 24 hours, identify which of these 5 habits is most active in your own financial life right now. Not the one that sounds most dramatic. The one that actually describes something you have been doing, something that has felt like discipline or caution or intelligence, but that you can now see, if you look honestly, is extracting a cost you had not been accounting for. Write it down. Name it. Because the habits that destroy wealth operate most effectively in silence. Naming them is not the same as solving them, but it is the only place to begin. The market will continue to move. Cycles will complete and begin again. The pendulum will reach one extreme and reverse. None of that is within your control. What is within your control is the quality of your thinking, the habits of mind you bring to every decision. And that, in the end, is the only thing that ever mattered. That's all. Thanks for watching.